here's a conundrum. What do you do when a fabulous company that's currently out of style in the Wall Street fashion show picks up a positive catalyst? Look at Emerson Electric. This is a classic industrial conglomerate, maybe one of the best we have in this country. It's a manufacturer's manufacturer, exactly the kind of stock that you do have to expect will get hurt during a global slowdown. A week and a half ago, we learned that D.E. Shaw, that's a major hedge fund that's also activist, has taken a position in Emerson. They may be pushing for big changes, possibly including a breakup. Now, I think Emerson's very well run, but this kind of activist attention tends to light a fire under even the best executives. Sure enough, last week, management announced a comprehensive review of the company's operational capital allocation and portfolio initiatives to enhance shareholder value. That's a quote, I'm sorry. Orderliness would make for a great story, but as Emerson itself will tell you, they expect, quote, a challenging geopolitical and economic landscape over the next couple of years. Ouch. So how do we weigh D.E. Shaw's activist intervention against the possibility of a slowdown-induced earnings swoon no matter what? All right, let's take a deeper look with David Farr. He's the chairman and CEO of Emerson Electric, one of our country's great leaders. Get a better read on how the company's doing and what's going on with this activist challenge. Mr. Farr, welcome back to Mad Money.
You.
Good to see you, David.
Good to see you again, Jim. Thank you very much for having us.
This has got to be, for you and for a couple of the real industrialists in this country, got to be one of the hardest times, because it seems like if it weren't for governments, you would be hitting it out of the park.
Well, you know, Emerson is performing well right now. We just finished our fiscal year. We're going to grow sales 5.5%. Our EBIT margin is going to be up. Cash flow is going to be up. We paid back over $2 billion to our shareholders. But clearly, the market dynamics are very difficult.
Yes.
And this June, I talked to the board about some major restructuring because of what I saw as a slowdown in this cycle, which is a little premature, between China, the United States, a very weak Europe. And I told the board, like we did back in 2016, we need to take a hard look at the company and say, what are we going to do to generate higher returns in a very no-growth market? Well,
you've been saying even yourself that before this D.E. Shaw position, you've questioned the actual makeup of the company, whether the divisions go with each other. But it's been historically a great way to do business.
Yeah, and when we put the company together like we did right now with those two platforms, we did this back in 2016. I firmly believe it's the right structure today. However, at some point in time, as I tell all shareholders who I meet with, we take a look at this constantly. The company I inherited from Mr. Knight back in 2000, I've sold off close to 60% of that company. We do the actions necessary to create value for a shareholder, position the company for the long term. But right now, we have a very difficult macroeconomic environment, as you well know.
Well, if an outfit that very smart guys like D.E. Shaw come to you, why can't you just say, hey, guys, look, it's not a good time. We're doing better than almost every other company in the industrial space. Why don't you give us a break?
Yeah, but I listen to all shareholders, Jim. I listen to all shareholders, short-term, medium-term, long-term. This board knows how to react. And so we had the plans underway. So, you know, last week we made the decision to announce so I could go out publicly and start talking to our shareholders. I wanted to hear what they said. And they basically made it very clear. You guys know what to do. You know how to generate the cash. You know how to pay money back to the shareholder. As you well know, we've paid back, since I've been CEO, close to $35 billion cash to our shareholders. And from the standpoint of dividends, we're going to be approaching 63 years of increased dividends per share. And we know what to do as a management team. The board knows what to do. So we'll take a look at all the pieces. We're going to take cost actions to try to grow earnings and create value in a marketplace that I think we're looking at for the next 2 years, potentially zero low-growth environment for a global industrial company like Emerson.
Well, one of the things that you did, you were far forward versus every other industrialist when it came to China.
Correct.
I mean, you understood that that had to be a huge part of your growth.
Correct.
It's been a fabulous place for you to do business. What do you do when suddenly the president's decided he doesn't want you to do business?
It's a lot more difficult. I mean, it's our second largest market.
But in the growth,
it's been very good. We've been growing there this year.
Tell people how many plants you have, how much exposure.
I have over 25 facilities in China. I have 10 engineering facilities in China. It's our second largest market. We grew this year in China. We'll continue to grow because the products that we sell, the industry, they need it.
Right.
But the big issue for us is the trade war between the U.S. and China. No leadership in Europe right now, no growth going on in Europe. I mean, so my decision is, okay, as I told the board back in June, we're looking at no growth. We got to look at how do we drive profitability, how do we drive cash flow, because our shareholders expect us to perform both in profit, returns, and cash, and turn that back to shareholders.
Okay, so there's a note here from Deutsche Bank on the 27th that says, CEO David Farr has publicly admitted that there are no real synergies between automation solutions and commercial and residential solutions, and it probably makes sense to split the two. However, timing needs to be considered. Farr has also announced that he plans to retire in 2021. He'd given an upcoming CEO transition the new guy should do it. Is it worth waiting after what you described?
I'm a CEO in action, as you well know.
Right,
so we're not going to take an action. So I think, from my perspective, the pieces do fit well together. There's always timing relative to when you create value in these pieces. As we just sold off 3 years ago, we sold a third of the company off.
Right.
From my perspective in the board's review, we see value in these pieces. However, at some point in time, everything sort of matures in valuation. You then make that decision and take that, sell that business off, and then invest in something else. In the last cycle, I got to buy the Pentair VNC business, the valves and control business, a great acquisition.
Yes.
And we have a lot of room to fix that business right now. As I do, as I look forward the next couple of years, I see a lot of restructuring opportunities in a no-growth environment where we could drive margins back up to peak levels of performance, drive strong cash flow, and invest that money for growth and maintain the franchises.
But David, if we get a trade deal, I don't want that Emerson. I want this Emerson.
Exactly right. And if we do get a trade deal, we'll be ready. But the big issue is we can flip back and forth. From my perspective right now, we're dealing in an environment where it's a tough environment for global act. So you need to get your costs in line. You need to take the actions. You can come off that and grow. You look back in 2002, 2003, you used to follow us.
Yes.
Where we made that
remember Mr. Knight. You kidding me?
You made that huge investment in China that we repositioned a third of the company. We had huge growth rate out of that. We grew 7, 8, 9% for 4 straight years. We leveraged the heck out of the company. I look at this as a unique opportunity right now to really set that cost platform and look at all the assets. And when I turn the company back over to the next generation in 2 years, they'll have a good run. And just like Chuck did for me in 2000. And so that's from my perspective how I look at it.
Well, this way, I'm always looking for the great industrial. It was GE. Suddenly I see all these problems, including pension problems. You don't have any of those. You got a great balance sheet. You are the industrial that I want to tell people to buy.
Correct.
But now I'm nervous that even you see slow growth. And while the pension's good and the balance sheet's good, maybe I should hold off.
Well, from my standpoint, I'm a big believer in industrial assets.
Right.
And you have to buy them in cycles because we are a cyclical business.
Right.
You have to keep that balance sheet very strong from the standpoint of you don't want to over-leverage the balance sheet because that's crazy to do because we want the unique opportunity to pick up assets.
Right.
And so from my perspective, I see in about 12 months, there are going to be assets in the marketplace. We're going to have that balance sheet to be able to pick them up, leverage that investments from that standpoint. But in the meantime, we're going to operate in a different market.
Doesn't these guys from Shaw, they're talking about levering up. That's not the right answer.
That's the wrong answer for a company like Emerson. Heck, someone told GE to lever up. You remember that? Buy back. I think there was an activist involved that bought a bunch of stock back and then did not invest in the franchises. The issue is you have to balance it. You have to invest in the franchises. Buying back $7 or $8 billion of stock is the wrong thing to do in a company like Emerson right now. Now, we can do different capital allocations. We can invest for the long term. But I like where we sit right now. We grew this year. I think we're going to have a growth period next year. But I'm looking at a different environment where you really need to focus on hard cost structures to make sure you can get that growth and you can leverage when you come out of it. That's what we've done in the past.
If you want an industrial stock, and I know most people don't because they're out of favor right now, Mr. Farr and Emerson, great way to go. Bad Money's back after the break.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.